Now that you know that you're eligible to opt into the scheme, it's time to analyze what's in the scheme, whether it's beneficial for you or not. We've already seen that there are advantages and disadvantages in both the situations, whether you opt in or opt out. If you opt in, you'll be relieved from all the complicated paperwork, but you'll lose out on input tax credit as well as collecting tax from your customers. While it's available for you, that option of collecting tax and claiming input tax credit, if you don't opt for composition scheme, but you'll also have to comply to all the procedural formalities. So the decision whether to choose composition scheme or not is based on two things: your cost and savings trade-off, your cost for maintaining a team, an expert team to comply the taxes for you, your cost of tax and your savings thereof. So a cost and savings trade-off has to be made along with judging your appetite for dealing with complications. So how exactly is the composition scheme going to reduce all your complications? We've already seen the procedure if you don't opt for the composition scheme. In normal scheme, you'll collect tax from customer, you'll issue a tax invoice, you'll claim input tax credit from your purchases, you'll have to maintain elaborate books of accounts for which you'll have to hire staff, maintain a tax team or experts in taxation. You'll have to undertake complicated tax liability calculations as well as appoint an auditor if you're required to audit your financial statements. You'll have to file monthly returns to the government which are very exhaustive, and you have to pay the net tax to the government, net of input tax credit. So we can divide all these processes broadly into four. First, customer related, second, supplier related, third, internal procedural related, and fourth, government related. We'll take up each of these steps one by one to analyze how it is currently and how composition scheme will change it for you. The first step is customer related. So if you don't opt for the composition scheme in the normal scenario, when you sell goods to your customer, you will collect some money. That money will be cost of your goods, including profit margin of course, and tax on that good. There are two components that you'll collect: your personal cost plus profit and the tax amount. In return, you'll have to issue a tax invoice. This tax invoice is as per section 28. Let's not go into the details of section 28 just yet. We'll look at it later, but know that section 28 lays out a complicated tax invoice description which includes a lot of detail for which proper systems need to be maintained. So this is the scenario for normal scheme. Now what if you opt into the composition scheme? How would it change? You sell good, that would obviously remain the same. Now, the money that you collect from your customer will not include tax. It will only include your sale price, your cost plus profit, and no tax can be collected from the customer. The second stage was issuing tax invoice as per section 28. You no longer are required to issue this complicated invoice, but only a simple bill of supply needs to be given to the customer in return for the sale. A very simple bill of supply which does not require a lot of details, just normal details that you see on any normal invoice. There are a lot of arguments against this provision because if proper invoices are not raised, traceable invoices, there are chances of tax leakages, especially direct tax, income tax leakages. Since the composition scheme is only for small businesses, the materiality of all these tax leakages are very small compared to the cost of collecting tax from all these small businesses. Remember, the cost of collecting tax for the government for small businesses who do not have any proper systems is quite high. So it's not just you who has to do the cost and savings trade-off, it's also the government. And so there are pros and cons in the first step itself. If you opt for the scheme, if you're married, you need not issue any tax invoice, so that's a big advantage, but you cannot collect tax from the customer, which is a huge disadvantage. And it's vice versa if you opt for the normal scheme. Moving on to the second step, which is supplier-related. A taxpayer following the normal scheme of taxation buys raw material from the supplier. Along with payment for the product, he would pay tax, and on this tax amount, he is entitled to claim input tax credit. So his expense that he recognizes in his books of account for purchases is only the actual cost of the product excluding tax. While in the composition scheme, because he isn't allowed to collect tax from customers, he cannot also claim input credit. The expense of purchases would increase because it would include the tax amount as well. For the taxpayer, there is a bigger disadvantage from not being able to claim input credit than only increased expenses. We'll talk about that later in a short while. So, from the second stage, supplier-related stage in the entire process, there is only disadvantage for the composition scheme, and relatively it is advantageous if you don't opt for the composition scheme.